Oklo Inc. is trading at $147.16, which is a gain of $9.03 or 6.54% on the day. Now, seeing a move like that, the immediate assumption for many is that this is just another volatile, high-growth name catching a speculative bid, perhaps swept up in the broader market currents. The expectation is that this is pure narrative-driven hype around next-generation energy. The reality, however, is that this specific upward pressure is likely tied to something far more concrete than general sentiment. We're seeing subtle but significant shifts in institutional positioning and a reevaluation of the regulatory timelines that the average retail investor, perhaps making trades on the Robinhood app, might be overlooking. The market seems to be slowly waking up to the fact that Oklo isn't just selling a concept, it's navigating a very specific and accelerated path toward commercialization that sets it apart from many of its peers in the advanced nuclear space. This isn't a story about a distant future, it's about the market repricing near-term probabilities. The common belief about a stock like Oklo is that you are buying a lottery ticket on the future of clean energy. It gets lumped in with hydrogen, fusion, and other long-duration technologies where the payoff is decades away. Investors see it as a binary outcome. Either it gets regulatory approval and changes the energy landscape, or it fails and the investment goes to zero. But this view is overly simplistic. It misses the nuanced reality of Oklo's business strategy and the incremental progress it's making. The deeper take is that the company's focus on smaller, factory-producible microreactors fundamentally changes the risk equation. Unlike massive, multi-billion-dollar conventional nuclear projects, Oklo's model aims for scalability and a much shorter construction timeline, which could allow it to sidestep the capital expenditure blowouts that have plagued the industry. The market is still trying to figure out how to properly value this approach, and today's price action suggests a contingent of investors is starting to believe the model has a higher chance of success than was previously priced in. Let's analyze the recent trading activity more closely. This 6.54% surge isn't happening in a vacuum. Trading volume today is running significantly above its 30-day average. This isn't just a handful of retail traders on SoFi Invest pushing the price around. Higher than average volume suggests conviction and the participation of larger players. These are the kinds of moves that signal institutional footprints. When you see volume confirm a price trend, it gives the move more weight. This isn't a low-float stock being manipulated. It's a response to new information or a change in perception filtering through the market. For investors managing their own portfolio, perhaps through an individual brokerage account at a place like Fidelity, recognizing the difference between a high-volume conviction move and a low-volume speculative drift is critical. The intraday chart shows a steady accumulation throughout the session, not a sharp, unsupported spike. This pattern often indicates that buyers are absorbing any shares that sellers are offering, confident in their position. This is a much healthier type of rally than the parabolic, short squeeze-driven moves we often see in more speculative corners of the market. The stock's behavior is also notable when compared to the broader energy sector and even tech giants like Nvidia stock, which have their own volatility drivers. Oklo's movement today appears idiosyncratic, driven by factors specific to its own story and its subsector rather than just riding a macroeconomic tailwind. Now, what does Oklo actually do? In simple terms, the company designs and plans to deploy small, advanced fission power plants. Their flagship product is the Aurora Powerhouse, a microreactor designed to produce about 1.5 megawatts of electric power. The key differentiator is the business model. Oklo doesn't intend to just sell reactors. It plans to sell power as a service through long-term power purchase agreements. Think of it like a utility provider for specific high-demand clients like data centers, industrial facilities, or remote communities that need reliable, carbon-free power. This model could provide a stream of steady, predictable revenue, a feature that distinguishes it from a pure hardware or technology play. Their technology uses a liquid metal coolant and can run on recycled nuclear fuel, which addresses some of the waste concerns associated with traditional nuclear power. Past performance shows a company that has been methodically working through the incredibly complex and stringent regulatory process with the U.S. Nuclear Regulatory Commission. While they hit a roadblock with a past application, they have since restructured their approach and resubmitted applications, indicating a resilience and adaptability that the market is beginning to reward. It's a long and arduous process, but each step forward de-risks the proposition a little more. For someone building a diversified portfolio, perhaps with a mix of Fidelity ETFs and individual stocks, understanding this business model is essential to grasping the true long-term potential beyond the daily price swings. Looking forward, the outlook for Oklo is a fascinating balance of immense opportunity and significant risk. The primary catalyst, without a doubt, is regulatory progress. Any positive announcement from the NRC regarding their combined license application would serve as a massive validation of their technology and approach. The expectation is for a long, drawn-out process, but the reality could be that renewed bipartisan support for nuclear energy as a key tool for energy independence and decarbonization could accelerate these timelines. We're seeing governments globally re-embrace nuclear power, and that political tailwind is a powerful force. Another major catalyst would be the announcement of a firm, binding power purchase agreement with a major customer. That would shift the story from a pre-revenue technology company to one with a clear path to commercial operations. Some of the most sophisticated trading, whether on professional platforms like Interactive Brokers or through wealth management services like Fidelity Wealth Management, is focused on trying to anticipate these inflection points. However, the risks are just as substantial. Regulatory denial or significant delays remain the single biggest threat. The NRC is rightfully cautious, and any unforeseen technical issue could set the company back years. Competition is another factor. Oklo is not the only company working on advanced reactors, and it competes not just with other nuclear startups, but with the falling costs of renewables like solar and wind, plus battery storage. Finally, access to capital is a constant concern. Developing this technology is incredibly extensive, and the company will likely need to raise additional funds before it starts generating meaningful revenue. The terms of that financing will be crucial. This is not a set-it-and-forget-it investment like buying a broad market index fund. It's an active, high-stakes proposition. It's a world away from the relative stability of Apple stock or even the calculated growth bets in the tech sector. Comment below what you believe is the biggest non-regulatory risk for Oklo's business model. Is it competition, securing fuel supply, or public perception? In summary, the narrative surrounding Oklo Inc. is often simplistic to a speculative bet on the future. The expectation is for extreme volatility driven by headlines and hype. But the reality of today's 6.54% gain, backed by strong volume, points to a more calculated reassessment by the market. Investors are beginning to appreciate the nuances of the company's business model, selling power as a service, and are pricing in a slightly higher probability of success in its regulatory and commercialization efforts. The contrast between the simple story of a moonshot tech stock and the complex reality of its incremental progress, institutional interest, and strategic positioning is where the real story is. The path forward is filled with potential catalysts and significant hurdles, but understanding the difference between the prevailing market expectation and the underlying operational reality is the key to making an informed assessment of its future. Please join our dialogue. Don't forget to like, comment, and subscribe for more finance updates. Make a slide layout PPT, minimum slide 12, 14.